In economies around the world, inflation is proving to be a bugbear. In the largest economy as well, in the US, inflation has run riot. And to control inflation, the US Fed has stepped up its effort by increasing the policy rates very sharply. As early as yesterday, it increased the rates by 75 basis points and it said that it might have to raise rates by 50 to 75 basis points in July as well. That is pushing bond yields higher in the US and it's causing nervousness in risk assets across the world. What is, if at all, the impact on fixed income assets here in India? How do you understand this global context and does it affect you? To understand this, I have with me Mr. DP Singh, who's the Deputy Managing Director and Chief Business Officer at SBI Mutual Fund. Thank you so much, Mr. Singh, for taking the time and congratulations on your new designation. Let me start by asking about this latest update by the Fed. In a sense, we were building to this, but the view and the expectation of that 75 basis points changed quite dramatically. In that, a couple of weeks back as well, they weren't expected to raise rates by 75 basis points. So, from the Indian perspective, how does the Indian investor understand this changing scenario globally, this uncertainty and volatility?
Yeah, first of all, thank you very much for having me on the show. And see, as your question, the US hike and its impact on Indian market and Indian movements of the interest rates. As far as the Fed is concerned, I think this was always already a writing on the wall that they will increase by 75 basis points. So it was almost a consensus in the markets because their inflation is almost 5 times more than their target inflation of 2%. As far as India is concerned, inflation is very high here as well, but this is within 30 to 40% more than the higher side of the target, which is we are talking about 2 to 6%. If we are having at 8%, that's almost see 25 30% more than the target, but there it is 5%. So five times, sorry. So that they have to take drastic action. It was writing on the wall, and it was factored in the rates also already. And the same was the case in India when RBI increased the rates by 50 basis points across the board. There also, I mean, the yields have not gone up very, very high. Now today also, a 10-year yield is at the rate of 7.61%, which was at 7.5152. So 10 basis point increase in the yields in response to the 50 basis point hike in the policy rates. So that's we have to look at, and we also have to be ready for another hike of say at least 50 basis points in the month of July. That may happen, and see market again will factor it in well before the time.
Okay, but I look at the 10-year Treasury rate, the bond yield there, and it's at 3.4, more than 3.4% at this point. And if you look at the dot plot that was discussed, there is an expectation that that policy rate can hit 3.4% by the end of this year. It can move to 3.8% in the next year. It can then move back to 3.4%. So we're looking at a considerable increase even from this point, Mr. Singh, in the policy rate, and one can therefore assume that the bond yield there will also move up very substantially. From the perspective of capital flows, then we're already seeing the impact in the equity markets here in India. Will that continue? Will there be a sizable drain that continues from the Indian markets then?
See, it's absolutely temporary, which we have seen in outlook, and we were recently attending one World Economic Investment Forum, and see today, the 3 years ago or 5 years, 4 years ago, nobody was talking about India being a very very small economy, and today, last week when we attended that conference, in each and every deliberation, India was being talked about. So India is a natural destination for the foreigners to put in money. As on date, they are wondering this is because whenever they have redemption, whenever people they want to put money in any other market, because our market has performed much better than other markets. We've been till recently, till last week, we were down only by 15%. So of course, today we can say we are down by 20%, whereas the other economies have gone down by 30%. So whenever they have redemption, they will definitely try to book profit where they are still sitting on gains. So that was the reason that we're getting money. I am not worried. I see this is an opportunity for putting more money who are having surplus in India, and the people who are sitting outside and looking for putting in money. I personally feel, I am fully convinced that we will see the reversal very soon, much earlier than we generally expect.
Interesting. I want to also talk about the Indian context, Mr. Singh, and you did refer to it just a bit earlier when you were talking about the Fed. Central banks, of course, across the world are contending with high inflation. And
Yeah,
the RBI has also raised rates by 50 basis points, and this is now on the back of that 40 basis point hike that was off cycle.
yeah,
So 90 basis points in the span of just a couple of months. As you were pointing out, on the long end, there hasn't been much of a change on the 10-year. So there was some amount of that rate increase that was baked in already. But
yeah,
before we
yeah.
get into the yield curve and what the meaning is for fixed income investments, I want to get your sense on where things stand, because the RBI clearly is doing a bit of a balancing act. It's controlling inflation or trying to control inflation. At the same time, it's trying to support growth. We're at a
Yeah,
time where it's absolutely crucial for that to take place. How do you see
yeah.
this dynamic panning out?
See, I am optimistic from 2 points of view. See, as far as first, I will talk about the rates. I can foresee that the rates which are there today, the policy rates, can within the next 3 to 6 months can reach as a 6%. Okay, 6% rate could be 6%, but that is the rate at which our yields may move to around 8.5%, 8 to 5%, which is very, very high, of course. But at the same time, from investors' point of view, there are two set of investors: one who are already invested in the long duration, and second is those investors who are going to put in money now. So how do they navigate? For them, they both have to have different strategies. First, the people who are already there for last 2 3 years, and they have a horizon of 3 to 4 years, the things will definitely balance out over a period of time. They need not be panicky at this point of time. And all those who are going to put in money now, there can be two strategies for the investors. One is, if they can wait for a while, they can put in money in the shorter duration funds, which are where the mark to market loss will be very, very minimum. And there's a possibility of getting a return of around 5.5, 6.5% kind of returns. So that is very much possible and visible. That can be done. Second is, if you want to lock in at these yields, then you have to go to the roll down strategy, which is a lot of funds are there, a lot of index funds are going to be there in the market. You can be part of it. Or you can wait for the timing, park money in the short duration fund. And once the things settle down a bit, maybe another 3 to 6 months, then you can put in money in the long duration fund. Then you will have an opportunity for some not only the yields but of capital gains as well.
Uh, I want to talk about that roll down strategy as well, just a bit. Or, they talk about structuring your investments over a period of time so that you have staggered returns over a period of time, right? And you're not
Yeah.
facing that volatility. Do you
Yes.
think, Mr. Singh, that now more than ever, it is important to educate the investor of the potential for capital loss if you hold money in longer term funds? They are more susceptible to capital loss if they book out. So, for example, in a gilt fund, which is a longer duration fund, how would you explain that duration risk?
See, it depends on which kind of how the fund is positioned. It depends upon the call. But as of now, when there's almost a unanimity amongst the investment managers, portfolio managers, that interest rates are going to fund up, and all these funds are going to be very, very dynamic, are being managed dynamically. I don't think at this point of time any fund manager will be keeping a 10 to 15 year or 20 year kind of duration in that fund. They will be on the shorter side. They will be having 1 or 2 year kind of duration. And there the loss probability of loss, a marginal loss, yes, but a big loss is not there in majority of the cases. I'm saying because I don't know how the funds are positioned. as of now and what are they going to. But when there's a unanimity, and most of the people will be on the shorter side. So yes, there's a need to educate people about the concept of mark-to-market losses. There is a concept of understanding the notional loss and actual loss being booked. So that's where the whole education part has to go into, and the managers and the fund houses are actually doing a brilliant job. They're reaching out to the people. I mean, if I take the example of SBM Mutual Fund, we are doing a lot of seminars. We are reaching out to people, telling them what it means for them. And today, if we have to suggest somebody, we are always suggesting very, very short duration. We are talking about money market funds, or we are talking about low duration funds, or we are talking about the target maturity funds, nothing else. But if there's once there's a clarity, we will definitely reach out to the people and tell them now this is the time, because nobody can say that now this is the peak or now this is the bottom. But there is always a likelihood. Debt fund, as compared to the equity funds, the visibility of bottom or peak is much more there than in the equity funds. So here we still, as of now, we in SB Mutual Fund feel still there's a room for interest rate getting hardened over the period of time, over the period of next 3 to 6 months. But there will be a good opportunity at that point of time to take a call on the long duration
Interesting.
funds.
Yeah.
All the long duration funds where people are still there, the duration of the funds is being played at a very, very low level. It used to be 15 years, 17 years. Today it is 1 to 2 years. I can talk about my fund house, and I am sure about other. Most of the matured fund houses will have the similar kind of strategy as of date.
Okay, so then let me ask you this. You've said that 3 to 6 months is when you see that bond yields will move up substantially.
Yes.
Can I say then that it is very likely that the 10-year bond yield will hit close to 8.25% or over 8% by March of 2023? And
Yeah.
from that perspective, that an Indian investor who is planning their debt fund investments or fixed income investments till
Yeah.
March of 2023 should stay, at least should stay in low duration, and after that they can start looking in target maturity. Is that fair to
So
say?
that's exactly what I said. I mean, there's a visibility of at least 8%, and if not 8.25, and people can I see all these are market-driven things. I mean, even if today 8%, even if today it's 7.6, 7.7%, people can definitely stagger. They can put 10, 15% at this point of time and then stagger over the period of time. But yes, my call will be that will be the time when to take a very, very long-term call. At this point of time, I will suggest that we should be in the shorter duration funds like money market fund or ultra short-term kind of funds for 3 to 6 months. I have absolutely am saying that.
Could you give us a sense then how you see the the yields on the shorter end developing then, because that will kind of give people a picture as to when they put money into these shorter duration funds for the next 7 to 8 months, what is their return expectation then broadly from those schemes?
See, we always see this is the surplus of money which people have at this when we are putting the short term where there's no benefit of short term capital gain tax. So naturally, it has to be compared with the short term deposit rates, right? So today the deposit rates, as far as saving bank interest is concerned, it's generally around 4%, 3.7, 2.7, 4, 4.5. On an average, it will be 3.5% if you put together all the rates. And if you look at the shorter term FDRs, these are in the ranges of 5.5% kind of thing, and the shorter duration. So from that point of view, these funds will definitely give you minimum 50 to 100 basis point more than that, because there's always a lag when the interest rates are increased, though banks have started increasing the deposit rates, but still there will be an alpha of around 50 to 100 basis point on the short-term funds. Because there was a period, say if I talk about 3 months ago, when we talk about the shorter duration fund, say liquid funds or money market funds, these funds are giving 3.5, 4% kind of return. And the bank deposit rates were either equal or higher than these rates. So naturally, there was a case to put money in the bank deposits. And as of today, things have reversed. The interest rates are around 50 to 100%, 100 basis point lower than the short-term yields which are there, which are in the hovering in the range of 6.5%. 6.5% kind of money where yields are there. Net of expenses, it could be 6.25% with a very, very small, definitely mark to market risk also. But this makes very, very good sense to park money into these kind of funds and see, of course, calculate that if you're putting money for 5 years, for 6 months, if you get 1.5% less, and for the remaining 5 years, you get 50 basis point more, which is more beneficial. That kind of thought process has to be brought in the minds of the world investors. And fund houses are there to play it very, very dynamically. We can, there are funds, we are educating people, we are educating distributors, we are educating banks to talk about these things.
Certainly what we're trying to do as well, Mr. Singh, but I also want, so you've said 8 to 8.25% on the long end, and you said as
Yeah.
things stand right now, 50 to 100 basis points at least is the kind of benefit that you can get in a ultra short duration fund, in the low duration funds that you get as compared to your bank deposits, right? Uh,
Yeah.
what I want to ask next is, while you see this 8 to 8.25 on the 10-year, where do you see the shorter end of the spectrum moving, considering that we could see repo at 6% over the next 6 to 7 months? A lot of people have spoken about the flattening of the yield curve in the past, and they've said that the shorter end of the spectrum, you'll see yields going up much faster than the long end of the spectrum. So therefore,
Yeah.
what I'm trying to get at is 6 months down the line, these low duration funds could yield much more than they are even now.
So that's fine, but then there's an alpha over the longer period,
Yeah.
right? And you have to put in for 5 years, you have to put in for 6 months. That is something you have to see. As of date, it's physical, right? That point of time, it may not be. And your second question, why I feel that it could go to 8%. The reason being, it's more than the interest rate. There's a demand supply function also which works. At this point of time, at a higher yield, buyers are not there. There are going to be sellers. Whenever there's a buying selling see mismatch is there or demand supply mismatch is there, sometimes yields move up, right? Today everybody is sitting on the same page, so in spite of 50 basis point, the yields have not moved. But can it continue to be like this for over the period of time, even if 50 basis point more there? I don't think so. Even not if the interest rate goes up by 75 basis point, so yields may move up at least 30 to 40 basis points. That is the premise on which I'm talking about it, and I wish that I'm correct, and I'm very happy if the interest rates don't move up too much, because that will not get to any capital loss on the existing portfolios.
One last question from my side. We are almost certain to see that interest rates will go up, bond yields will go up. How long do you see this sustaining? Because a lot is at play, right? We spoke about it at the start. We're talking about pretty elevated rates in the largest economy in the world that could last to well beyond 2023, or at least till 2023, assuming that there isn't a recession or something like that that would cause them to lower rates again. Do we then say that this higher interest rate scenario, which we seem to be moving into, will last for a while?
Yeah, I think so, because see, we have seen these cycles earlier also. We are in the business and the asset management business for the last 32 years. This is not the first time this is happening, but this time the circumstances are totally different. This is the circumstances. I mean, suppose tomorrow the whole crisis, Ukraine crisis, was the goes away, and the fuel prices come down drastically. Will and the inflation comes drastically down. Can there be no change in the circumstances? Yes, there will be. So then the things will move pretty in the betterment side. So these are the possibilities which may be there, and I don't foresee any big move from here on. Going on, let's see, what you talked about the recession. As far as US is concerned, people are concerned, and Europe definitely. People are very, very much concerned because they don't have any manufacturing. They think everything is imported. So the those developed countries are also looking at the recession, and it may not set in. So these are some of the risks which we are facing all across the world. So India is not, we cannot be unscratched from these things. But although we are having a very big benefit of demand, domestic demand itself. That's a big benefit for us that will continue to play around. And I want to be more optimistic than pessimistic. I don't want to see a doomsday kind of situation very soon. But I'm of the opinion this what we are talking about 8% or what we are talking about the short-term interest rates. This is something where our ability, where visibility can go. Beyond that, what will happen? It's not known to anybody.
And just to your point of staying optimistic, Mr. Singh, it remains the case that India, as a large economy, continues to be the fastest growing, and we hope that that continues to be the case. Pleasure speaking with you, Mr. Singh, and looking
Thank
forward
you.
to our next chat already.
Thank you very much.